Hello, everybody, and thanks for joining us today on Friday, the 11th of April, to go through an investment market update for about 30 minutes. Thanks to all of you for joining us today. I appreciate it is short notice, but given the turbulence in markets, we felt it suitable and appropriate to have a webinar this week before the weekend to give all of you an update as to where markets are and what's happening at the moment in the current environment. Just a bit of a logistics running order. Most of you will be familiar with Zoom. You can put questions to myself and Ian Slattery through the little Q&A button in Zoom. Your questions are anonymous in that we can receive them and see them, but no other attendee can. As you will have seen, this webinar is being recorded. So we've got lots of content to get through in a fairly short amount of time. So if you do miss anything, we will send a recording on afterwards to watch it back. And we'll also send the slides on so that some of the detail you can spend more time examining it afterwards, especially when it comes to charts and graphics and things like that. Most of you know me as clients of Compass Private Wealth, Jonathan Shane. I'm delighted that Ian Slattery from Zurich Life decided to join us today. Zurich actually had a webinar yesterday for us, for all their other advisors. So it was timely that they were preparing a lot of slides, and I asked Ian at very short notice to speak, and thankfully he dropped everything and decided to join us. So you'll be hearing from Ian later on in the session. So in terms of what the agenda is, I'm going to just start off talking about what has happened with Trump's tariffs. I won't spend too long on it because most people are very familiar with what's happening given the extent of the media coverage it's got so far. And I'm going to show you lots of different charts in terms of what's happened with investment market performance, both on a year-to-date basis, but I've also gone back 3 years. I've looked at bonds, I've looked at currencies, as well as global equities. Then I'll just touch on one slide and just some key summary points with markets, just to explain and rationalize where we are, because we are in the eye of the storm. And I guess one of the outcomes I'd like from today is just to give everyone a kind of wider lens and a step back to say, okay, what exactly has the impact been on portfolios, on investment markets, and what should I expect for the remainder of 2025? Ian and I will speak about 3 different themes. Ian will explain the reciprocal tariffs and the formula that the US came up with. We talk about inflation and interest rate expectations. It's easy to forget about interest rates and inflation in the current market turmoil, but this is a big theme, and it will be a big theme for another while. So we'll discuss where inflation currently is and what the future inflation and interest rate expectations are. And then we'll have a couple of slides on long-term investing, again, just to give perspective as to step back from the short term and look at what the long-term historical picture says. And finally, at the end, I'll have 10 key bullet points with summary messages, and we'll have a Q&A where we'll take the slides down and we'll field questions that have come in throughout the session. Okay, so what has happened in simple terms? In the months leading up to Trump being elected, traditionally, equity markets favor a Republican president, as we know. So markets were quite positive leading up to November. From when Trump was elected, before he was inaugurated, but from when he was elected up until about mid-February, we had a sustained bull market rally. And I've mentioned in a further slide that the US stock market hit an all-time high on the 19th of February, which is about 7 weeks ago. 7 or 8 weeks ago. So markets had a very strong start to Trump's presidency. There's obviously other factors here as well. It's not just about Trump, but just in the context of what we're speaking about today in this webinar, I want to just make this specific to Trump. From mid-February until the end of March, there has been a bit of a change, as we know. For the 6-week period, markets started to get nervous, and the year-to-date performance, positive performance up until mid-February, turned negative in the US by the end of Q1. So by the end of the first quarter, US market was down about 4%, or just over 4%, but down by over 8% in euro terms. So if you just look at up until Monday of last week, the 31st of March, Q1 was a negative market, but not overly negative for equity markets, but it had sold off from the highs of mid-February. So what we then had last Wednesday in the Rose Garden, and it was timely that the announcement happened after the US market closed. As you know, the Irish and European markets open from 8 a.m. to 4:30 p.m. US opens at 2:30 p.m. Irish time until 9 p.m. And then obviously Asian markets are overnight. So like when advisors like us look at markets, you're always looking at what Asia did overnight, how Europe opens, and then you can see what the US futures are. But Trump made his announcements after hours on Wednesday night of last week. And I guess that really, really spooked markets, the extent of the reciprocal tariffs, which Ian will touch on later on. And markets sold off very, very aggressively on the Thursday and the Friday of last week, and following through slightly to Monday of this week. Then on Wednesday, which surprised me that the announcement on Truth Social was made during US hours, but on Wednesday evening, Trump came out and announced this 90-day pause, with the exception of China at the 125%, which we're all aware of this and what happened. So we saw a huge bull market rally on Wednesday evening, and US was up nearly 10% in one day, which is just huge for a basket of 500 stocks to be up an average of 10% in one day was absolutely unprecedented in some ways. And it's funny, even when I was chatting to Ian before the webinar this morning, and I was looking at prices, like even on an intraday basis, prices are changing. So US markets futures turned positive like 10 minutes ago. They were negative an hour before that. So things are changing very rapidly intraday. So in the following charts, I'm trying to paint a picture as to where we are at this point in time. So how severe has the sell-off been? You can see here that in the 3 days, Thursday, Friday of last week and into Monday, it ranks with one of the worst. You look at Black Monday, 2008, COVID. So down by almost 11% in 3 days is quite significant. I'm going to go through these charts quite quickly because you can look back afterwards. But essentially, before I go into the charts, I just want to speak about the relevance of the US market. It accounts for 2/3 of the MSCI world. So two-thirds of the global equities are US equities. So it is obviously very relevant. The dollar is the reserve currency of the world. The president, whoever it might be, is arguably the most powerful man in the world. The US is the largest issuer of debt in dollar terms. So therefore, weakness in the US stock market does have a knock-on impact into global trade and global profitability. And then people often ask, like, well, what difference does it make? Why do stock markets hate this? Because maybe tariffs might favor US companies and different things like that. Well, they don't. Any barrier to free trade is bad for free markets. It's bad for company profitability. So therefore, it's bad for share prices. And markets just hate uncertainty. They really, really do. And we're going to see a lot more uncertainty over the next 90 days or so until these negotiations play out. What changed Trump's mind last Wednesday? In my view, it was the spike of the US government debt, because anybody can handle equity market volatility. It doesn't have a real impact into the US Fed or into the US government. But when the cost of borrowing in the US Treasury market, when that actually increases, that's a real cost. That's the only thing that can really get the attention of Trump. And when that increase, I think Trump actually alluded to it. So that certainly was of relevance. And unfortunately, that yield hasn't really come down even since Wednesday, even though markets popped on on Wednesday evening. Government bond yields haven't done too much since then. So potentially a lot of the damage has been done, which tells me that I think there'll be some more news in the next couple of weeks, because it may not be that sustainable given debt markets where they are. This is the US. This is 6 major indices, stock market indices, year to date in local currency. So you'll see here, just to put context into it, the US market by S&P 500 is down 10% in dollar terms year to date. As you'll see here, which is the DAX 30, the top 30 companies in Germany, is actually positive year to date. So a lot of people forget this, because we're looking at the highs of mid-February, but actually on a year-to-date basis, other markets are somewhere in between. I suppose the most relevant for everybody is the MSCI World, which is which is down just under 9% year to date, because that takes the basket of all global indices into an aggregated index, the MSCI World. Now, if you look at the exact same chart, but in euro terms, you'll see the S&P 500 is down just under 17%. And that's because the dollar has weakened, which has been a kind of a double hit to Irish investors, unfortunately, this year. And I'll show you a slide shortly on the dollar versus the euro. Just to give you a wider lens, this is the same 6 indices, but over 3 years. So forgetting about what's happened in the last 6 or 7 weeks or what's happened in the last week, this is over the last 3 years. So, it really does show that time in the market is the most important thing, that we're always going to have setbacks. We can pick any period back here in 2022 and it'll sell-offs along the way. Yes, this is quite severe, but over the long term, equity markets will always perform better than cash. It's just about having the long-term time horizon. This is the dollar performance here to date, okay? Which is quite relevant because Irish investors investing in dollar, the dollar weakens. It's obviously bad for us as investors, okay? So that's a very, very big factor. We then look at starting the year at 103.5 and up to about 113 as of last night. So it's very, very significant. And this ultimately is the effect of what Trump is doing, that it's weakening the dollar, as in other currencies are strengthening relative to the dollar. So that is bad. It's good if you have borrowings in dollars, but it's bad if you have assets in dollars. And no matter what, if you're an Irish investor, be it a charity, some of our charity clients are here today and are in a family or whatever it might be, for you to diversify, you have to take on non-euro exposure, because the Eurozone is such a small part of global market. So it's inevitable that if the dollar is between 65 and 70% of the MSCI World, you have to take on dollar exposure. So that's been a negative so far this year. These are bond yields. As you'll see here, the cost of borrowing in the US has actually decreased ever so much so far this year. And Germany, which is the bellwether in Europe, has slightly increased. The reason why I'm showing you these charts is because, there's been a bit of a spike here in the dollar cost of borrowing over the last couple of weeks. But still, bonds as an investment are relatively flat year to date. So all the bad news out there, the German stock market is slightly up. The European markets generally probably an average down a couple of percent. Bonds are relatively flat. Just US and Asian markets are the most badly affected. So key points here before I go into the chat with Ian. The S&P did hit an all-time high. So we're coming from a high point. So the sell-off we've had is coming from an all-time high, the 19th of February. By tonight, based on estimates of future prices, it looks like the US will be down about 20% tonight in euro terms. Technically, a correction is a 10% peak to trough. Bear market is 20% peak to trough. So we're not technically in a bear market in dollar terms, but we actually are in euro terms in terms of the S&P 500. Dollar weakening has made a huge impact, as I said earlier. European markets are roughly flat year to date. Now, there's very few people who have said at the start of the year, I'm going to put all my equities or all my capital into European equities. So just want to mention it. And as I said, bonds have not been as impacted by equities at all. So I know I rushed through a lot of points there, okay, in terms of charts. So when I send out the slides afterwards, you can spend a bit of time. So Ian, thanks for joining us. Tell us what you think.
Yeah, no, thank you. Thanks for having me. It's great to be here. And good afternoon to everybody on the call as well. A week is a long time in politics or whatever narrative or quip you want to use. It's been a hectic week for us in investment markets, and look, I think you summarised it very well in terms of what we've seen. And look, I think some of the turmoil will continue. We're dealing with kind of very binary outcomes based on, as you said, posts on social media or whatever it might be. So yeah, the falls have been very quick and sharp. But I think it's very useful the way you framed it in terms of the perspective, going back to even the start of this year or 2 or 3 years past as well. So look, interesting times as it always is.
So, Ian, can you firstly just explain, this was in your slide deck yesterday, but the formula for the reciprocal tariffs?
Yeah, you've added the tariff kind of worms there. So I think this is just useful to frame the context and the conversation. We'll all have heard the fallout, and we've discussed it here. But um, for us at Zurich, two reasons why the reaction was so severe was firstly the percentages themselves. So the percentages were bigger than people have expected. But secondly, that was accentuated by what we're showing you on the screen here at the moment. So if I start on the bottom left, the formula that they applied was in and around a trade deficit. So the difference between what you import and export to any individual country, from the US's perspective, and then you divided that by total imports, and they arrived at a tariff piece. So just to kind of explain that, I suppose, I always like to use the kind of the worked example is always easier for me to understand. If we take the example of Bangladesh, the US has a trade deficit of about $6 billion. What that means is that the US imports about 8.5 billion from Bangladesh, but Bangladesh only imports about 2 billion from the US, the other way around, right? So essentially, if we move to the bottom right, then what we have is you take that 6.2 divided by 8.4, you come out at a figure of 74%. They then apply a discount by dividing it on two, and then you get this 37% reciprocal tariff. So if anyone remembers, or you have a quick look online there at the now infamous board that Donald Trump had in the Rose Garden, the figure for Bangladesh would have been at about 37%. To put it politely, this would be quite an unconventional approach from an economic perspective. There's not much rationale or precedent to arrive at a tariff like this. So that again was the worry for markets. It wasn't just the level of tariffs; it was the logic or lack thereof behind it. And the worst offenders, again, that's the wording from the US administration. So who are the countries or the currency blocks that they're keeping a close eye on this? So on the left-hand side in the red bars, we're showing you the trade deficit the US has, those imports minus exports figure in billions. So you'll see that China and the EU and indeed Switzerland are the big ones there. And we also just pulled out Germany and Ireland, which contribute massively, I suppose, to the overall EU figure. And obviously, there's some EU figures, countries that are in surplus, which is why the average is there. Then on the right-hand side, we have the US tariff in percentage terms that applies to those individual countries and currency blocks. So you can see there, before the announcement 2 days ago that about the 90-day pause, the EU has been hit with a 20% tariff. Just to note for anyone who's interested on the call, if Ireland was treated independently from this economic perspective, we would actually incur a higher tariff. So in terms of being part of the EU average, that's been a positive. So Jonathan, that's just a little bit of an attempt to explain where they arrived at the figures, whether it makes sense or not. And in terms then, secondly, on the second slide, the company, or excuse me, the countries that were hit most by this. And I know, look, the narrative has moved on a little bit. It's fast moving, as they say.
Yeah, thanks very much, Ian. And I guess the biggest theme we've had for the last couple of years for the tariff theme has been inflation, interest rates. So that's the next theme I want to discuss. And I'm just going to firstly show you a slide here on where Ireland is in terms of inflation. So we're currently here, so amongst Eurozone countries, we're at a very, very good rate of inflation. So below 2% is exactly what central banks would want, and what exactly what our government would want. And just again to show you a bit of context as to where inflation was At the peak in 2022, we were close to 10%. And when inflation was at 10%, the fear, I suppose, is that it will continue above 10%. But thankfully, it has come down. I guess a concern now is what's going to happen with inflation and interest rates. So, Ian, I
Mm.
might just pass back to you, and if you just talk about here the expectations we have going forward.
Yeah, so just to reiterate what Jonathan said there, particularly in Ireland, we're in good shape with inflation. Now, I know we don't always feel that, particularly I know when I don't want to go to the supermarket, for example, but overall, the prices aren't lowering, but they're not moving higher at the same rate as before. And why that's important is we need to think about how inflation impacts on interest rates and how interest rates impacts on economic growth. So what we're showing you here is in the dark lines is the cuts, the interest rate cuts that have been delivered by the big central banks, and we're going to focus on the bottom two, the Federal Reserve in the US and indeed the ECB, European Central Bank here in the Eurozone. So we've seen a 1% or 100 basis points from the US. We've seen 1.5 from Europe. And then the lighter shaded area on the right hand side shows what more cuts the market is expecting. Okay. So the market is expecting a good few more cuts from the US and indeed Europe as well. What will be muddied the water a little bit in the last few days in relation to this is that it's very hard for central banks to react to this sort of information that's happening with the tariffs. Tariffs themselves are inflationary, okay? So depending on who bears the cost, there will be higher taxes or higher prices for companies to protect their margins. But someone somewhere pays more when tariffs are initiated. Okay, so that's not good for free trade, as Jonathan said earlier on. That lead to inflation most likely somewhere. So it's very hard for Jerome Powell, who's head of the Federal Reserve, to figure that out. But he has to work through it in relation to full employment and the inflation figures as well. But why this is important and taking again a bigger, wider lens here, I suppose a bit more big picture, which is what we're trying to do at Zurich as long-term investment managers, is I'm showing you here is the expectation for a 5-year inflation figure in 5 years. So the 5-year in 5 years. So essentially, why this is important is that it has come down, particularly in the US, from where it was even just a year ago. So why that is important for us is medium-term inflation expectations remain anchored. And I think that's really, really important for us. It's very loud and noisy at the moment, the impact of tariffs, the potential of delayed or accelerated interest rate activity from central banks. But I do think if we keep that kind of medium term focus as investors, it's not bad news in relation to inflation and indeed lots of other metrics. Okay. So employment in the developed world is very, very strong. Inflation is coming under control. Growth is continuing. We're seeing the kickoff of US earnings this afternoon from the banks as well. So this is a huge if, and I'm going to smile as I say this, it's a huge if. But if you see a resolution from the tariffs, the underlying fundamentals from the economy are in pretty good shape.
And Ian, and that brings us into the third theme, which is about long-term investing. And it's something that I touched on, that we've had a lot of volatility and noise in the short term. But I guess when you look at it, everything from a long-term perspective, you might just talk us through the next couple of slides here, Ian, on intraday falls as part of being part of investing.
Yeah, so I really like the two slides we're about to talk through here. I think they stand the test of time throughout history. So I'll just take a moment to explain this particular chart before we move to the next one. But what I'm showing you here is the European stock market. So not the best performing in the world over the long run, but not the worst in the short run, as we've shown already. So look, a fairly okay metric to use here. And the blue bars are showing the return for Eurozone equities in any calendar year going back to 1980. So you can see the big fall of minus 41% in 2008. And you see the more ups than downs over the long run. What the red dot is showing you, however, is not the calendar year return, but the peak to trough. If you bought and sold at the worst time in any of those years. So the two big points on this chart is notice how in almost every instance, the red dot is below the blue bar. The blue bars aren't always positive, but the peak to trough is almost always going to be worse than what you actually experience over that particular year. And the second point on this chart is, I think that's really, really important at the moment is if you look at the very right-hand side, overall markets up to a couple of days ago, you'll see the red dot, the peak to trough in 2025 for Eurozone markets, minus 13%. So we talk about how fast the fall has been and how it hurts us behaviorally. Pretty much that isn't actually that far off what you might have seen as an average over the last 45 years in terms of a peak to trough. Not to say it won't continue and might get a little bit worse, but in history, we can actually expect to see these sort of peak to trough movements in any calendar year, albeit it's been pretty fast in the last week or so. So I do think it's as the slide says, intraday falls are very much part of investing. This second slide as well, just again taking a moment to explain it. On the left-hand side in the dark blue, I'm showing you the rolling 1-year potential return for equities. So this is global equities, and in terms of the US market, so a decent proxy for global equities, going back well over 50 years. In any one rolling year, you might have seen plus 61% in equities or minus 43. So a big range of potential returns. In the beige, we're showing you bonds, and then in the lighter blue, the 50-50 portfolio, just for illustrative purposes. But notice, and I won't bring you through all the bars, thankfully, you say, but if I move from left to right, just notice the two things that happen about your potential range of returns. Firstly, the range narrows. So the longer you invest, the more certainty you have in your returns. And secondly, it skews upwards. So both the certainty, you have more certainty in returns, and those returns are more likely to be positive. So it just shows that I suppose the fact that long-term investors do tend to get rewarded, which I understand can be hard to take on board when we're just this wall of worry in terms of news flow, but stepping back and taking a look at some of these principles is important.
Thanks for that, Ian. So we're nearly at the end. I may not be able to squeeze everything into 30 minutes because there's a couple of questions that have come in. Of course, log off whenever you want and we'll send the recording on. But I just want to go through a few key principles before we go into the Q&A. And these principles are always going to be in place regardless of what the market environment is. So none of us here can control what's happening in markets at the moment. Think of the smartest person you know. And if you think of the smartest person you know and imagine he or she dedicated his or her life to analysing US stock markets and economics and different things, and they wouldn't have predicted this the case. So let's just boldly understand that no matter what happens today, what happened last week, what happens next week, we can't control it. Always think long term, which has been a key theme, I think, of this presentation. It's all about diversification. All the clients of ours on this call know that that's always what myself and the team preach all the time. There's a lot of sensationalizing markets. Like, look, it is very severe what's going on at the moment, but sometimes the way the media portray things, it's like complete Armageddon. So just step back from time to time. There is a lot of sensationalization going on at the moment, but always look at things in context. Oftentimes people ask me quite frequently in the last while is there anything we should do? But the way the stock market works is that it happens instantaneously. If bad news happens, the prices have dropped before you even have a chance to do anything. So that's the way equity markets. It's not like a property which might take months to feed into prices or interest rates. With equities, it happens instantaneously, and markets do look about 9 months in advance. It's time in the market, not timing the market. Anybody who tries to be clever and buy and sell and tries to be smart in that way is usually a recipe for disaster. And I've seen this over my 20-year history in investment management. So it's just about, sometimes you have to accept that if you don't have too much risk, like if you don't have too much in any one company and you're broadly diversified, there will be depressed periods of time with valuations. But if you have the strength and the conviction to hang on, it's about time in the market rather than timing the market. Always expect the unexpected. Can't ever be complacent. Something could happen this afternoon or next week that we can't foresee at the moment. And always beware of biases and never get complacent. When things were positive in 2023 and 2024, people may have had recency bias, but they're thinking, well, things were up by 20% in the last couple of years. That's going to continue forever. So I suppose our job as holistic wealth managers is to be aware and educate clients what their biases might be, but also the biases of different market commentators. And, and I always give the example of if somebody has some surplus funds to invest and they go directly into an investment institution rather than going to a holistic advisor like us, it's like going into a car garage and asking them, should you buy a car? The answer is always going to be yes. Going directly to an investment institution is always bad advice because they have biases, their own proprietary product biases. So always getting holistic advice is important. Avoid unnecessary risks, mitigate risks, any risks that you can't control, and always consider holistic asset allocation. So if and when portfolios are impacted by markets, you always need to look at, well, what percentage of my overall asset base has that been? Is it 10% of it? Is it 50% of it? Is it 80%? And if that percentage is too high, that's where rebalancing and structured asset allocation might make more sense. So that's all our slides. We have a couple of minutes for questions. We have one question here that's come in, Ian, I might put it to you. How do you anticipate negotiations to go over the next 90 days with China and with all the other reciprocal tariff countries?
If you've hit me with a hard one straight out the bat there, it's going to be interesting. Okay, so the conventional wisdom when this began was this was a negotiation tactic, and the US administration would renege a little bit, and we'd see how we go. I think one thing that's important to note is there has been a reprieve on many of the tariffs, down to the normal 10% tariff, as we can now call it. But it's interesting to note that given the move that have happened between China and the US in the last 24 hours, there are more actual tariffs globally now than there was previous to the reprieve announcement on Wednesday. So I think that's just a little bit of context for people to think about as well. Ultimately, we do believe a deal gets done because it has to get done for the most part. I do think the geopolitical implications of this will be massive. We've seen the United Arab Emirates and the EU start to open trade negotiations. We've seen a lot of Japanese and Chinese companies start to do more work in Southeast Asia. So that's going to go on for a very long, long time. But I do think ultimately we see some sort of reduction of the tariffs. But the big caveat of that is we don't know when that'll happen, and we don't know the journey for stock markets between now and when that happens. Yeah. So I might sit on the fence a little bit on that one.
Just one final question then before we finish. Question is coming here asking, does it suit Trump that the dollar has weakened so much?
He likes the idea of a weaker dollar. It's something that he has been very explicitly on record for saying. He thinks it makes US exports, so goods leaving the US are more attractive because they're cheaper in theory for, say, us in Ireland to buy. So yeah, he does like that for sure. But it's such a complex economic background insofar as how does a weaker dollar impact the amount of debt that the US has, the treasury yields it has, how does it impact what the Federal Reserve might do. But sorry, to answer the question, I suppose on a simple level, yes, Donald Trump favors a weaker dollar. Whether that makes sense or not is a different point. Yeah.
Folks, we're going to leave it there for today. We've got a couple of minutes over. I really, really hope you benefited from this. I know we squeezed lots of content in there. We'll send the slides and recording out. Big thank you to Ian Slattery for joining us today. Ian, we really appreciate it at short notice, and you spent lots of time preparing the slides. So thanks very much for that. Thanks to all of you guys who joined us. Any questions, direct them to myself or any of the team, and we look forward to seeing you again soon. Thanks, everybody.
Thanks, Jonathan. Thank you, everyone.